Welcome to Agrivisions, a program of First Dakota National Bank. I'm your host, Nate Franzén, President of Ag Banking at First Dakota. And it's my pleasure today to have one of our very own, Jayson Plamp, with us. Jayson is Vice President of Ag Banking in our Mitchell market, one of our leaders in our Ag Banking team, and we're so glad to have Jayson with us. I got to believe, as you've been meeting with clients, interest rates have maybe come up in today's environment.
Yes, they have. We're in just a different environment, as you know, than we were a year ago. I mean, prime rate, we got pretty used to being in that 3 to 4%. Yep. And now we're at almost 8. Yep. And it sounds like that's going to continue to go up on some level, but nobody really knows. Right. And so we've had a lot of conversations surrounding that. And the conversation always goes like, gosh, I don't expect you to like this, but right. Here's what the reality of things are today. Now, luckily, we've had a lot of guys that have locked in some really advantageous rates in the past, but that doesn't help those who are watching us today and haven't. So
right. And that's one of the things I would say I'm most proud of our team for is, because of the tools we have in our tool belt as ag bankers and our philosophy to always be trying to look out for the best interest of our clients. Coming out of historical low rates, we really did aggressively help our clients lock those rates in and take advantage of those low rates. And today that's certainly paying for a whole bunch of those folks.
It most certainly is. Yeah. And an interesting corollary is a lot of times we would see these higher interest rates put a lid on land prices. It doesn't seem that we've seen that today. And so I'm going to watch that closely, as I know our viewers are too, and see if that ends up playing out or not. But the book says it should put a lid on that.
Yeah, and I may add a little of my thoughts around that here as well. I think because of what you talked about earlier, the strength of agriculture, the profitability that's been in agriculture the last couple of years, it's offset some of the impact of that rising rate, at least for now. But if you're right, and I'm not arguing with you, we're going to see a little tightening of margins, and if grain prices start to get some downward pressure, it'll be interesting to just watch what the impact of that'll have on ag land prices as we go forward, both in a higher rate environment and maybe a tightening margin environment. I would think then maybe the fundamentals will start to weigh in a little harder.
Absolutely, and also it's hard to forget the asset that brought you to the dance, so to speak, and those who have had land, it's treated them very well, and so that certainly plays into the decision going forward too, I would imagine.
Yeah. Back to the interest rates, are there strategies you're helping your clients think about as far as managing this inflationary environment? Are there things that you're pointing to and helping folks really evaluate to improve their position?
Sure. Well, looking at interest rates, we try to say maybe it makes sense to go with a 1 or a 5-year variable as opposed to going all the way out to a 30-year. The nice option that we have is we're always able to refinance or reprice into a longer term if we go down the road and rates do fall. And I do believe they will at some point. But also use these interest rates as a negotiation tool with whoever you're buying your asset from and try to illustrate to them that this has some effect on your overall cash flow and therefore probably your ability to pay up for the large capital asset.
Yeah. I've heard you say this and I want you to elaborate a little bit more. Beating inflation versus participating with inflation. Tell me what you think about there.
Well, there was a lot of discussion coming into this year, this fall in particular, about hey, I need to buy this piece of equipment because I need to beat inflation. And the conversation always came back to, well, if it's gone up by 40%, you're just participating. You didn't beat it, now you're just owning it. And it'll be interesting. I don't think inflation stops until we stop seeing those big purchases happen. And so a lot of what we've talked about is, well, hand to mouth, so to speak. Buy what you need today, but maybe isn't the day to go try to turn over an entire equipment line to try to beat inflation, because I think that opportunity is in the rearview mirror.
So repair versus replace may have more merit today than it has at other points in time.
More than ever, and especially if you have
Yeah.
the ability to do your own repairs. You know,
Yeah.
that's becoming a harder and harder thing to find the labor to do it. But if you possess that skill set to be able to maintain and repair your own equipment, I do think there's some merit in it.
Yeah.
But with that being said, I think there's an emotional turmoil aspect that I get to this whole thing too, to be working on stuff all the time. I encourage guys to have a capital replacement plan. You know, go out there and lay out your next 5 to 10 years worth of purchases so that you can say, well, I only have to Band-Aid this thing together for one more year and it's on the plan to get replaced.
You bet. The other great advantage of that is as you're managing cash flow, repayment, working capital levels, you can build that right into that capital replacement plan, right? So that
Absolutely.
that you're not in a desperate mode of replacing something when financially you'd rather not have to.
Right. And I do think it keeps from that knee-jerk reaction that this thing broke down for the last time and it's out the door today.
Sure.
You know,
Sure.
so.
Yeah, makes good sense. I'm going to put you on the spot, Jayson. As you said earlier, nobody knows for sure where things are going, and I think we all agree with that, and our listeners will respect that. But give us your best crystal ball. Where do you think we're headed? What do you think's lying in front of us here as it relates to inflation, the economy, and how that's going to impact agriculture?
Well, I won't charge you anything for this, so I'll give you my double your money back guarantee. But I kind of have a target for prime rate, which is now at 7.75. I really think that's going to go to 8.5. I think that's where we got to get before we start to see things tighten up a little bit. And who knows, maybe it'll go a touch higher than that. There's a lot of talk right now that rates are going to start coming down. Sure could.
Yep.
I think a lot of things have to go wrong in the economy before that happens, and I'm not hoping for that on any level right now. I think healthy is we keep this quarter point up for a little while longer, and we'll sure see. I mean, you know, the yield curve right now is starting to tell us maybe we're topping out a little bit, but I've seen the 10 years kind of fluttering around right there right now. So
Yeah. I don't want to leave you on an island, so I'll give you a little of my thoughts around that too.
Thank you.
You know, I agree with you, and I agree with what you're saying. I tend to think we've got a little more upside ahead here before we're going to get inflation to really turn the corner the way we need it to. I am starting to see some signs that we could be there, and you know from hearing me here over the past several months that I've been pretty firmly convinced that, you know, the yield curve that is predicting a recession sooner than later and a drop in rates, I've been skeptical of that. And you know that. You've heard me say it multiple times. I am seeing some evidence that maybe that is starting to move closer. And one good way I've looked at that is as we look at peer banks that we compete against, which we monitor ourselves and track ourselves against, we look at their loan deposit ratios and how much liquidity banks have.
Right.
And if we go back 6 months ago, there was gobs of liquidity in the banking sector. After looking at year-end numbers now and a sizing up where we're at, that liquidity is shrinking and loan to deposits are rising. That tells me the liquidity is coming out of the market. And
working exactly the way the Fed wants it to,
that's
right?
what's supposed to happen
Yes.
when we raise interest rates, right? And so thinking that that's the case, you know, maybe gives me a clue that maybe we are reaching the top sooner rather than later. The million-dollar question nobody really knows is, okay, will rates come down? Probably, but how far, right?
Right.
And you know, for historical perspective, I think we can probably both agree that, you know, 3s and 4s is not a normal interest rate. That's where we've come from, but that's not normal. You could make the argument, really, where rates are today is close to historical average. So I do think rates will come down. I bring this up only to say, hopefully you're not out there counting on rates going back to the 3s and 4s where we came from.
Correct, yeah. Well, and if you look at it from a financial health standpoint for our country,
Yeah.
the biggest weapon that the Federal Reserve has is its ability to control the money supply and therefore interest rates. And when we are down at 3 1/4, they've got a 6-shooter with no bullets in it.
That's right.
And so one could say that this is the sign of a much healthier economy, because then when something bad does happen, they can react and make a meaningful impact.
The other side of that really may impact our viewers here is When borrowing rates are in the threes, that means if you have excess cash around, you're a depositor, you're not getting paid much
Right.
for those
That's-
dollars,
that's
right?
changed,
And
yes.
that's changed. And maybe that's healthier too for economy, right? Where you have borrowers paying a reasonable rate, but depositors able to get a fair return.
Absolutely. You think of the little old lady who's trying to get by on her CDs.
right.
This will make her life easier.
That's right. That's right. Well, Jayson, anything we haven't talked about that we need to as you think about what's ahead of us and conversations you're having with your clients?
I just think that I'm bullish agriculture. I'm optimistic. I think there's a lot of good things coming our way, but I do think it's a tightening cycle, and we just have to be cognizant to stay on the top side and not to accrue losses in some of these times that I think are going to go down as some of the gravy times in our industry.
Yeah. And I will echo that. I'm bullish on ag as well, but I'm also really bullish on First Dakota and our ag team because of people like this guy right here. And in future segments, you're going to get a chance to hear from others across our ag banking team. I couldn't be prouder of the team we have and the work they do to help strengthen the industry and help our clients be successful. Thanks for being with us for another Agrivisions.